once the volatility index moves into a certain range, and I like to think of it above 20, when the VIX closes above 20, that's where, and again, if you look at this, you'll see that this is when you got to at least start thinking that it could be a bear market, and you want to protect yourself accordingly. Hello and welcome. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And today I want to go over the volatility index and how you can use this as a sentiment indicator to get a better feel for whether or not we're in a bear market, potentially in a bear market, or whether the bear market thoughts may have ended. So the first thing I want to do is just show you the long-term chart of the VIX. If you look at this chart, you can see that it started back in 1990. So what I'm going to look at are all the bear markets that have happened since 1990. And let's take a look at what the VIX tells us. Now, keep in mind, a lot of folks refer to the VIX as the fear gauge, because essentially what it is the market makers are looking out over the next roughly about 30 days and trying to determine how much volatility they expect in the S&P 500 over those next 30 days. And they price options accordingly, those short-term S&P options. And based on how those options are priced, it actually is used to calculate the VIX itself. A higher VIX means that the market makers are expecting a lot more volatility, and a lower VIX means market makers are expecting a lot lower volatility. And if you know anything about volatility in the VIX, it's that higher volatility generally means lower equity prices. Normally, when stocks are going up, even if they're going up a lot, the VIX doesn't move to the upside, even though there's a lot of movement in the index. It's when the index moves down, when the major indices like the S&P 500 start to move down quickly, that's when the volatility index will build. So watching the VIX and looking at the VIX and seeing how it's priced gives you a little bit of a clue into what the market makers see over the next 30 days or so. So that's a big key component. There are a lot of folks that look at the VIX and say whenever the VIX is low, you want to short. You want to short the market because the VIX is too low and it's going to rise. And that means when the VIX rises, the S&P 500 goes down. Seems like pretty good thought in theory, but it just doesn't work. In 1994, I just circled on this chart the 3 times the VIX has gone down and consistently, or at least for a period of time, what goes below 10. When the VIX goes below 10, that's meaning there's not really hardly any expected volatility. The first one of those readings was 1994. What happened? Next 5 or 6 years were 5 or 6 of the best stock market years in history. You would not have wanted to be shorting the market in the latter half of the 1990s. The second one came at the end of 2006 as we were going into 2007. And if you recall, ultimately, the bear market led by that financial crisis started in October of 2007. So this reading, you might say, hey, that was a pretty good call. Maybe it was time to start shorting. And then the third time it went below 10 was back in 2017 into early 2018. We did have a cyclical bear market at the end of 2017, the end of 2018. But the first 9 months of 2018 were pretty solid. So, and once we got past that cyclical bear market, the market took off again. So I don't really think that was a very good call in terms of wanting to short the stock market. So I don't think it's as easy as doing that. I think instead what we want to do is follow the VIX and see when it crosses through some key levels. Let's go through some bear markets all the bear markets since 1990, and let me show you how the VIX acts. So this is the 1990 bear market. This was the top in July. The bottom hit in October. Pretty steep decline. We were down a little over 20%. And during this move, we had 2 what I would consider to be pretty significant rallies. Overall, we went down, but we had 2 significant rallies. What I want to show you is that during those rallies, the VIX lows came down only to about the 27 level, 27, 28. Now, the significance is, and what I want to point out throughout all these bear market charts, is that first of all, I look at the 17 to 20 level on the VIX as kind of that, things are about to get really bad, or has the market just hit a bottom? And now we're okay because we're going to, the VIX will go back down and the market will go higher. Well, you don't know that at first. You got to, once the volatility index moves into a certain range, and I like to think of it above 20. When the VIX closes above 20, that's where, and again, if you look at this, you'll see that this is when you got to at least start thinking that it could be a bear market, and you want to protect yourself accordingly. And it usually happens very early in the bear market. So it can get you out at or near market tops. But one thing that is consistent among all bear markets is that the VIX is normally above 20. And all bear markets require fear. And the VIX being the fear meter, we need to see that fear pumped up. That's the common denominator. It's kind of like thinking about, weather patterns. You get lots of thunderstorms come through your area, but not always do you get a tornado threat. The conditions have to be ripe for a tornado. And that's kind of what I look at the VIX. The VIX is like one of those conditions for a market tornado or a bear market. And so first thing you need to see is a VIX go through 20. We've never had a bear market. I can promise you, even before 1990, before the VIX was created, there was never a bear market without fear at the, early in that bear market. There has to be fear because that's what creates or helps to bring on that panic selling, impulsive selling that we see in bear markets. So you've got to have the fear. So what I'm going to mark on all these charts is the big red arrow that comes down marks that move through 20 on the VIX. The horizontal dotted lines mark the beginning and end of the bear market. The thick red arrow here or directional line here marks the entire bear market, as does it mark the VIX over 20. And then I've got two key lines down here below. The really thick one is 17. That's because once a bear market starts, historically, I've said a lot that it never goes below 20. And as I looked at these, I have to be corrected. Sometimes it goes just slightly below, or I say never goes back down below 17. I think I may have said 20. But it actually has gone a little bit below 17, down into the 16 and a half, 16 3/4 range. So let's call that floor on the VIX somewhere between about 16 and a half and 17. That if you can get that VIX down below that range, that essentially tells you you're out of a bear market, that the conditions are no longer right. And so I'll show you what I mean as we go through every one of these bear markets since 1990. This was the 1990 Persian Gulf War bear market. There was a recession, blah, blah, blah. I'm not going to talk a lot about the fundamentals. Just look at the VIX. Here it's going down. The VIX goes through 20. During the entire period of the bear market, we never saw the VIX go down below 17. It continued to rise. Even during market rallies, the VIX would drop, but it was still well above that 17 level.
Enjoying the content? Hit the like button and subscribe for more insights delivered directly to you.
Move on, 1998. There's that 3-month, 2.5, 3-month decline from July through early October. Here was the breakout on the VIX above 20. Like I said, these breakouts above 20 generally happen pretty early on in a potential bear market, which is why I am extremely cautious when we get a close above 20. It doesn't always lead to a bear market, but it should always lead to you being cautious, because bear markets are where you're going to have the biggest drawdowns in your account. If you're on the long side and you see a VIX get through 20, you better at least be thinking about putting protective puts in place, selling calls against your position, doing something to negate the risk, that the new risk that you now are encountering. Anyway, during this period, really only one significant rally. And you can see during this rally, the VIX came back down only to about 32, nowhere near 17. So the VIX remains elevated. And as long as that VIX remains elevated, you need to be careful. Now, a lot of times a bear market will end with that VIX very elevated. We don't know exactly until we get confirmation down the road. There may be other signals, but if you're looking at the VIX exclusively, you're not going to get confirmation until the VIX is back down below 17. So this is just one signal, but it's a pretty good one to follow, I think. Next up, the 2000, 2002 secular bear market. Much longer, as you can see, between these red dotted vertical lines. That's a long time drop right there. Now, we had many rallies You see five, what I consider to be five pretty significant rallies during this bear market. And yet here is where we broke out. There was the top. Here was our first move through 20. We never went back down below 17 until sometime after the secular bear market had ended. So again, every one of these moves back to the upside, we never saw the VIX move back down below 17. The VIX was elevated. Conditions remained ripe for further market tornadoes. The 2007 to 2009 bear market. Look at that. VIX, or excuse me, S&P 500, another big drop. Here are those counter trend rallies back to the upside, marked with these circles. Here we came down right to 17. This was in May 2008. We got right down to about 17, then popped right back up again. So it never continued. Now, if you looked at the price action, you might just say, hey, we're moving back up. We got through moving averages. I don't show the moving averages here, but in 2008, this did go back above some key moving averages. You may look at that and say, hey, we're out of the woods. Well, the VIX would have said differently. The VIX would have said, hey, yeah, we're dropping, but let's get through 17, 16 and a half, 17. Let's confirm. Never did. That VIX remained elevated. And then later is when we hit the depths of that financial crisis. And you can see the VIX. That was the time where we went up to 90 on the VIX. Next bear market, 2018. This was the trade war, very, very quick cyclical bear market. We had a few rallies in between. Look when we broke up above 20 early on in the bear market. When did we go below? Now, this is a couple of these circles down just a little bit below 17. I'm going to call it 16 and a half. But again, bouncing off of that level, going back up, and then ultimately breaking back up through 20 and going all the way up to 36 at the end of the bear market. So again, watching the VIX, keeping it in mind, we never really got that definitive confirmation that the bear market was over, and that led to one more big decline in December. 2020, this is the pandemic, very quick, straight down move. Only one rally at all really in here. Most of the rallies were just a gap up in one day and then right back down afterwards. Very, very quick, huge drop in the S&P 500 as folks came to grips with our first pandemic in 100 years. And you can see, where did the VIX go above 20? Very early on, way up here, long way. I mean, we lost a third of the market's value after the VIX hit 20. And on that one rally attempt, VIX got back down into the low 30s, and that was about it. The 2022 cyclical bear market. This one lasted about 9 months, a little over 9 months, but you can see pretty big decline. Look at all these rallies. I counted 5 really nice rallies. When did the VIX go above 20? VIX went above 20. And you can look back, by the way, a VIX moving through 20 doesn't guarantee we have a bear market. What it should do is just turn on that that caution light, or the caution flag should be raised. That's what it means to me when I see the VIX go through 20. Then I got to see confirmation. I need to see major breakdowns, price breakdowns. And then that really starts to make me think, okay, we got some issues. So anyway, here, 2022, it was in the middle part of January, before we went in through all of this pain, that we got the signal on the VIX. Be careful. We never saw the VIX get back down below 17 until sometime much later after the bear market ended. Now, looking at 2024, a lot of folks, we had this big drop. Say, okay, this is the bear market. Is it the bear market, though? I mean, initially, yeah, I was a little concerned. I mean, especially right around that last Fed meeting, end of July, early August, that's when the VIX finally broke above 20. It actually broke above 20 right in here on this big drop. So yeah, the next couple of days were pretty scary. But look at this first rally. First rally is coming back up, and we're all the way back up near the all-time highs again. And by the way, if we break to a new all-time high, everything before that high can be thrown out the window. So all of this, it's not the start of a bear market because we got an all-time high. You can't have an all-time high in the middle of a bear market. So it's possible another bear market might start from that new all-time high, but once you get a new all-time high, you're not in a bear market. The other thing is, look what during this rally, look at what happened to the VIX. We never saw this in any previous bear market. None of them. VIX, 5 or 6 days now in a row, we've been below 17. We got down to 14 and change. That never happened. Now, I'm not saying it can't happen. Anything can happen. There's a first time for everything, right? But I'm just saying, if you're only looking at the VIX, when the VIX goes back down below 17 and stays there, it's confirmed like it has been recently. To me, that's a signal that this is not a bear market. One last chart I want to show you, and this is since 2013. That was the time the S&P 500 took out the highs from 2000 and 2007. So at that point, all the secular bear market consolidation and selling was behind us. We broke out above the double top. And in that moment, which was on April 10th, 2013, I said a new secular bull market was born. Now, technically, it was born back in 2009 at the low, but you didn't know it was the low. You don't know it until you get the confirmed breakout. So a stock that's downtrending and is at a low, you're not going to look at it and say, well, it's breaking down. It's its lowest level ever. Let me jump in because this is the start of a bull market. We don't know if that's the start of a bull market in that stock or in the index. Not when it's at its low. We need to get confirmation of that uptrend. We need to get the breakout. And that happened in 2013, April 10th, 2013. Since April 10th, 2013, when the VIX closes at these various levels, this is how the S&P 500, this is the return we get. So when the VIX closes above 20, every day that the VIX closed above 20, since April 10th, 2013, the annualized return on all of these days is minus 36.74%. So if you want to be long when the VIX is over 20, have at it. But the odds tell you it's not a good time to be in the stock market. When we're between that 17 to 20 range, that cautious range, the S&P actually performs okay, gaining annualized return anyway, gaining 15.29%. When you're between 13 and 17, which is where we are right now, that annualized return grows to double what it is in the 17 to 20 period, and it rises up to almost 31%. And when we're below 13, getting low in the VIX, when some people think, oh, when the VIX is low, that's when you want to short. Well, I mean, you can argue with the numbers if you want, but when the VIX is down below 13, the S&P annualized return is over 47%. So the higher the VIX goes, the lower the stock market returns, and the more you need to be concerned. When the VIX comes back down, it means the fear is coming out of the market. And when the fear comes out of the market, the S&P 500 tends to rise. Anyway, that's a great lesson, hopefully, on the VIX. Maybe you didn't know about, but watch the VIX. It's a great sentiment indicator, and it does give us a lot of clues as to whether or not we're in a bear market, whether or not we need to be cautious. Keep those levels that I showed you in mind. Happy trading, everybody.